On August 15, 1971, at 9 p.m. Eastern Time, President Richard Nixon appeared on television and killed the gold standard. With one executive decision, he severed the last link between the US dollar and physical gold, a connection that had existed for centuries. Within weeks, $500 billion in global currency values were suddenly floating in uncertainty. Within decades, the purchasing power of every dollar in your wallet had been permanently altered. But this wasn't a rash decision made in a moment of panic. This was the inevitable collapse of a system that had been cracking for years. A system built on contradictions that could never be resolved. And understanding how it happened reveals something crucial about the financial system we live in today. Because here's what they don't teach you in economics class. The entire modern monetary system, the one that governs your savings, your investments, your purchasing power, began with a default. The United States, the most powerful economy in the world, simply decided to break its promise. And the pattern that led to that moment? It's repeating right now, with even larger numbers and higher stakes. To understand why Nixon killed gold, you need to go back to 1944. World War II was still raging across Europe and the Pacific, but Allied leaders were already planning for what came next. In July of that year, delegates from 44 countries gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. Their mission was ambitious: design a new global financial system that would prevent another Great Depression and avoid the currency chaos that had fueled the rise of fascism in the 1930s. The system they created was elegant in theory and revolutionary in practice. The US dollar would be backed by gold at a fixed rate of $35 per ounce. Every other major currency, the British pound, the French franc, the German mark, the Japanese yen, would then peg to the dollar at fixed exchange rates. This meant that indirectly, every currency in the system was backed by America's gold reserves, which at the time were the largest in the world at over 20,000 tons. Here's how the mechanics worked. If France accumulated dollars through trade and wanted to redeem them for gold, they could present those dollars to the US Treasury. The Treasury was legally obligated, to exchange those dollars for physical gold at $35 per ounce. No questions asked. This created discipline in the system. The United States couldn't just print unlimited dollars because other countries could drain America's gold reserves if they lost confidence in the currency. For the first 15 years or so, this system worked beautifully. The 1950s and early 1960s saw unprecedented global economic growth. International trade exploded. American companies expanded overseas. The dollar became the world's reserve currency, not by military force, but by trust. Countries willingly held dollars because they knew those dollars were as good as gold. But there was a fatal flaw built into the Bretton Woods system from day one. A mathematical contradiction that economist Robert Triffin identified as early as 1960, now known as the Triffin Dilemma. Here's the problem. As the global economy grew, the world needed more and more dollars to facilitate international trade. But the only way to supply those dollars was for the United States to run trade deficits, to import more than it exported, sending dollars overseas. However, the more dollars the US created and sent abroad, the fewer gold reserves backed each individual dollar. Eventually, inevitably, the math would break. There would be more dollar claims on American gold than there was actual gold sitting in Fort Knox. And when that happened, countries would lose confidence. They'd rush to redeem their dollars for gold before everyone else did, and the system would collapse. Triffin warned about this in 1960. He testified before Congress. He published papers. He explained the math clearly, but nobody in power wanted to listen. Because acknowledging the Triffin Dilemma meant admitting that the Bretton Woods system had a built-in expiration date. And in the early 1960s, with the economy booming and the dollar strong, that seemed like a theoretical problem for some future generation to worry about. By the mid-1960s, That future was arriving faster than anyone expected, and almost nobody in power wanted to admit it. In 1965, President Lyndon Johnson made a choice that would accelerate the crisis exponentially. He decided to fight both the Vietnam War and fund his ambitious Great Society programs simultaneously. The war required massive military spending, troops, equipment, weapons, aircraft. The Great Society required massive social spending: Medicare, Medicaid, education programs, urban development, the war on poverty. Both were expensive. Both required enormous government outlays. And Johnson famously said he could have both guns and butter, war abroad, and social programs at home. But here's what he refused to do: raise taxes significantly to pay for either one. Why? Because raising taxes was political poison. It would have been deeply unpopular with voters and could have cost Democrats control of Congress. So instead, the government ran larger and larger budget deficits. The Treasury issued more bonds. The Federal Reserve expanded the money supply to accommodate the spending. More dollars flooded into the system without any corresponding increase in gold reserves. Foreign central banks started to notice. By 1967, the ratio of U.S. gold reserves to outstanding dollar liabilities had fallen to dangerous levels. In practical terms, this meant that for every $1 backed by actual gold in Fort Knox, there were now $4 held by foreign governments that could theoretically be redeemed for that same gold. The math was simple and terrifying. If even a quarter of foreign dollar holders decided to redeem their dollars for gold simultaneously, Fort Knox would be empty. French President Charles de Gaulle was the first major leader to call America's bluff. Starting in 1965, France began systematically converting its dollar reserves into physical gold. De Gaulle was furious about what he called America's exorbitant privilege, the ability to print the world's reserve currency at will and use it to buy real goods from other countries. In his view, the United States was exporting inflation to the rest of the world, while France and other nations had to maintain strict fiscal discipline. So France sent ships, actual naval vessels, to New York to pick up French gold from the Federal Reserve. Between 1965 and 1968, France converted $3 billion into physical gold and transported it back to Paris. De Gaulle was making a statement: "We don't trust your paper. We want real money." Other countries watched this carefully. If France could do it, why couldn't they? West Germany began converting dollars to gold. Spain did the same. Even Britain, America's closest ally, was quietly reducing its dollar holdings. To defend the $35 gold price, the United States and 7 other nations had created something called the London Gold Pool in 1961. The way it worked was this: whenever market demand for gold pushed the price above $35 per ounce, the pool members would sell gold from their reserves to push the price back down. It was price manipulation on a global scale, central banks actively suppressing the free market price of gold to maintain the official fiction that gold was worth $35. For several years, this worked. But by late 1967 and early 1968, the pool was hemorrhaging gold. Private investors, foreign governments, and speculators were all buying gold faster than the pool could supply it. They could see the math. They knew there weren't enough U.S. gold reserves to back all the outstanding dollars. So they rushed to convert paper into metal before the window closed. In March of 1968, the crisis reached a breaking point. In just the first 2 weeks of March, the London Gold Pool lost 1,000 tons of gold. That's 1,000 tons in 14 days. At that rate, the pool would be completely drained in a matter of months. On March 15, 1968, the London Gold Pool collapsed. The central banks announced they would no longer defend the $35 price in private markets. From that moment forward, there would be 2 gold prices: an official price of $35 per ounce for transactions between central banks, and a free-floating market price, which immediately jumped to over $40 for everyone else. This was the beginning of the end. The system had split into two parallel realities. The official reality, where governments pretended gold was still worth $35, and the market reality, where gold was clearly worth much more because nobody trusted the dollar anymore. When Richard Nixon took office in January 1969, he inherited this currency crisis in slow motion. His economic advisors presented him with three basic options. Option 1, raise taxes substantially and cut government spending dramatically to reduce the deficit and restore confidence in the dollar. Option 2, impose wage and price controls to fight inflation and buy time. Option 3, abandon the gold standard entirely and let the dollar float. Nixon hated all three options. Raising taxes and cutting spending was political suicide. He just won the presidency and wasn't about to torpedo his own popularity. Price controls felt un-American, a violation of free market principles. And abandoning gold? That would be admitting that the system had failed, that America had broken its promise to the world. So Nixon chose a fourth option: delay, deny, and hope something changed. For 2 years, he tried to muddle through. But the numbers were relentless and unforgiving. U.S. gold reserves continued to fall. They dropped from over 20,000 tons in 1958 to just 8,100 tons by 1971. Meanwhile, foreign dollar holdings kept rising. By early 1971, foreign central banks and governments held $80 billion in claims, backed by only $10 billion worth of gold at the official price. That's an 8-to-1 ratio. For every dollar of gold, there were $8 of claims. The promise was mathematically impossible to keep. In May of 1971, the crisis accelerated dramatically. The German central bank, the Bundesbank, made a devastating announcement. They would no longer defend the fixed exchange rate between the Deutschmark and the dollar. They were letting the mark float freely. Within hours, $1 billion flooded into Germany as investors, and speculators bet that the mark would rise in value against the dollar. They were right. The mark appreciated significantly, meaning the dollar had effectively been devalued against Germany's currency. Other countries quickly followed Germany's lead. Switzerland floated its franc. Austria revalued its shilling. The Netherlands let the guilder float. The entire system of fixed exchange rates that had been the foundation of Bretton Woods was disintegrating. Then came the moment that forced Nixon's hand. In early August 1971, the British Treasury quietly approached the United States with an extraordinary request. Britain wanted the U.S. to guarantee the value of Britain's dollar holdings against devaluation. Think about what that means. Britain, America's closest ally, the United Kingdom that had fought alongside the U.S. in 2 world wars, was essentially saying, "We don't trust the dollar anymore. We want insurance." If Britain was asking for guarantees, other countries would follow. And the U.S. government couldn't possibly provide those guarantees, because honoring them would require resources America simply didn't have. The gold window was about to be stormed by every country holding dollars, all demanding gold at once. Nixon's advisors knew the game was up. They had days, maybe only hours, to act before the crisis became unmanageable. On Friday, August 13, 1971, President Nixon summoned his top economic advisors to Camp David for an emergency weekend meeting. This wasn't on his public schedule. A meeting was held in complete secrecy. Treasury Secretary John Connally was there. Federal Reserve Chairman Arthur Burns, Chief Economic Advisor Paul Volcker, Budget Director George Shultz. Together, they represented the highest levels of American economic policymaking. The question on the table wasn't whether to close the gold window anymore. That decision had effectively already been made by events. The real question was how to announce it to the American public and the world without triggering immediate financial panic. Arthur Burns, the Federal Reserve Chairman, opposed closing the gold window entirely. Burns was an old-school economist who believed in monetary discipline. He warned that abandoning gold would unleash inflation, destroy the dollar's credibility as the world's reserve currency, and create chaos in foreign exchange markets. He argued passionately for a different approach: austerity. Raise interest rates to defend the dollar. Cut government spending. Accept a recession if necessary. Tough it out and maintain the gold standard. But Treasury Secretary John Connally saw things very differently. Connally was a tough-talking former Texas governor with a ruthless America First mentality. He famously told the group, "The dollar may be our currency, but it's your problem." What he meant was clear. Let foreign countries deal with the consequences of dollar devaluation. America would do what was best for America, and if other nations didn't like it, that was their problem to solve. Connally argued for bold, decisive action. Close the gold window immediately and unilaterally. Impose a surcharge on imports to reduce the trade deficit. Freeze wages and prices temporarily to control inflation. Shock and awe. Make it look like strength, not weakness. The debate went on for hours. Burns continued to object, warning of long-term consequences. But Nixon ultimately sided with Connally. The political calculus was simple. Nixon needed a strong economy for his 1972 re-election campaign. Austerity would mean recession, higher unemployment, angry voters. Closing the gold window and imposing popular-sounding measures like wage freezes and import tariffs? That could be sold as protecting American workers from foreign speculators. By Sunday afternoon, August 15th, the decision was final. Nixon would address the nation that evening. At 9 p.m. Eastern, millions of Americans tuned in to their televisions expecting a routine economic update. What they heard instead was one of the most consequential financial announcements of the 20th century. Nixon spoke for about 25 minutes. He announced a 90-day freeze on all wages and prices to combat inflation. He announced a 10% surcharge on all imports to protect American jobs. He announced tax cuts for businesses to stimulate investment. And then, almost casually, buried in the middle of the speech, he announced this: "I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets." That one sentence changed everything. But notice the word temporarily. Nixon didn't say he was ending the gold standard forever. He said it was a temporary suspension until international monetary reforms could be negotiated. But everyone in that room at Camp David knew the truth. There would be no going back. The gold window, once closed, would never reopen. Temporarily was a lie designed to soften the blow. Most Americans watching that speech didn't understand what Nixon had just done. They heard wage freeze and protect American jobs and thought it sounded reasonable. They didn't know what the gold standard was, let alone why it mattered. The mainstream media coverage focused on the wage freeze and import tariff, treating the gold announcement as a technical adjustment. But central bankers around the world understood immediately. The Americans had defaulted, not on bonds, not on loans, but on the fundamental promise that had underpinned the global monetary system since 1944. Emperor had no gold, and everyone could see it now. When markets opened on Monday morning, August 16th, chaos erupted. The Japanese stock market crashed 4%. European currency markets gyrated wildly as traders tried to figure out what currencies were worth without fixed dollar pegs. Gold prices soared in private markets. Within weeks, the dollar had lost 8% of its value against major currencies. For ordinary Americans, the immediate impact was mostly invisible. You couldn't see the gold standard ending when you bought groceries or filled up your car with gas. Prices didn't double overnight, but the long-term consequences would reshape the American economy for generations. Without the gold anchor, the Federal Reserve could now create dollars without any external constraint. The discipline of potential gold redemption was gone forever. There was no longer any hard limit on how many dollars could be created. Money had become purely fiat. Its value derived entirely from government decree and public confidence, with nothing tangible backing it. And what followed was entirely predictable if you understood monetary history. The 1970s became a decade of persistent, grinding inflation. By 1980, just 9 years after Nixon's announcement, the purchasing power of $1,971 had been cut nearly in half. A dollar that could buy a gallon of gasoline for 36 cents in 1971 couldn't even buy a candy bar by 1980. In December 1971, just 4 months after Nixon's announcement, the world's major economies gathered at the Smithsonian Institution in Washington, D.C. to negotiate a new monetary framework. They agreed to new exchange rates, with the dollar officially devalued against gold from $35 per ounce to $38, though this was now purely symbolic since dollars still couldn't actually be redeemed for gold by foreign governments. Nixon stood in front of the press and declared the Smithsonian Agreement the most significant monetary agreement in the history of the world. It was a characteristically Nixonian piece of hyperbole. In reality, the agreement lasted barely 14 months before it too collapsed. By March 1973, the world had moved to completely floating exchange rates. No gold backing, no fixed rates between currencies. Currency values would now be determined purely by market forces, supply, demand, speculation, and trust. This was unprecedented in modern history. For the first time since the ancient world, no major currency was backed by precious metal. Money had become completely abstract, its value determined by nothing more than collective belief and government power. The immediate aftermath of the Nixon Shock brought exactly what Arthur Burns had warned about: inflation. Lots of it. The Consumer Price Index, which had been relatively stable for decades, began climbing relentlessly. By 1974, inflation hit 11%. By 1980, it peaked at 14.5%. Interest rates followed, reaching 20% by 1981, as Federal Reserve Chairman Paul Volcker desperately tried to restore faith in the dollar. An entire generation of Americans, anyone who came of age in the 1970s, learned to fundamentally distrust the stability of the dollar. They watched their savings lose purchasing power year after year. They saw interest rates on mortgages and car loans reach levels that seem unimaginable today. The social contract around money had been broken. But here's what many people don't realize. The Nixon Shock didn't just change currency mechanics. It fundamentally altered the relationship between governments and money. Under the gold standard, governments faced real constraints. If they spent too much, ran too large a deficit, or inflated the currency too aggressively, they'd face gold redemptions and currency crises. There were consequences for fiscal irresponsibility. After August 1971, those constraints disappeared. Governments, particularly the U.S. government, could now fund deficits simply by creating new money. The Federal Reserve could expand its balance sheet without worrying about gold reserves. The temptation this created proved irresistible. U.S. federal debt, which had been relatively stable as a percentage of GDP for decades, began its permanent upward trajectory after 1971. It's not a coincidence. Without gold discipline, there was no brake on government spending. Politicians could promise more benefits, fight more wars, fund more programs, all without the immediate pain of tax increases or the immediate threat of currency collapse. The pattern here is crucial to understand because it repeats throughout monetary history. The Nixon Shock followed the exact same arc as every other fiat currency collapse, from the Roman denarius to the French assignats to the Weimar German mark. First came the complacency phase. In the early 1960s, everyone believed the Bretton Woods system worked perfectly. This time is different, they said. We've learned from past mistakes. We have sophisticated central banks and international cooperation. The system is stable. Then came the excess phase. running larger and larger deficits to fund the Vietnam War and Great Society programs. Next was the warning phase. France redeeming gold in 1965. The London gold pool collapsing in 1968. Germany floating the Deutschmark in 1971. The warning signs were everywhere, flashing red, impossible to miss, but mainstream institutions insisted everything was under control. "Don't worry," they said. "We're managing the situation. We'll negotiate reforms. Trust us." Then came the acceleration phase. In 1971, events moved from manageable concern to full crisis in a matter of weeks. Once confidence broke, it broke completely and quickly. The end came faster than anyone expected, even though the underlying problems had been building for years. Finally, the collapse itself. The system that had governed global finance for 27 years ended in a single Sunday night television address. One speech, one decision, everything changed. Understanding the Nixon Shock teaches us something profound about monetary systems. They are not permanent features of nature, like gravity or thermodynamics. They're human constructs, political arrangements, built on promises and sustained by confidence. And they're subject to the same political pressures, mathematical contradictions, and human psychology that had destroyed currencies throughout recorded history. The Bretton Woods system failed because it promised something it could never deliver: unlimited dollar creation with limited gold backing. The contradiction was built into the system from day one at that hotel in New Hampshire in 1944. It just took 27 years for the mathematics to catch up with the political promises. What Nixon did on August 15, 1971, wasn't revolutionary. It wasn't even particularly creative. It was inevitable. When governments promise more than they can deliver, when the math doesn't add up, when the claims exceed the assets, they will eventually choose to change the rules rather than face the political consequences of keeping their promises. The only question is when. And the answer is usually later than the skeptics predict, but sooner than the optimists hope. So why does a decision from 55 years ago matter today? Because the same fundamental pattern is unfolding again in our current monetary system, just with different players, different mechanisms, and much, much larger numbers. The Nixon Shock taught us to watch for very specific warning signs. And if you know what to look for, those same warning signs are flashing today. Warning sign number 1. Mathematically unsustainable deficits and debt. In 1971, foreign dollar claims exceeded U.S. gold reserves by 8-1. Today, the U.S. federal debt stands at approximately $36 trillion and rising. That number is so large, it becomes almost abstract. Your mind can't really grasp what $1 trillion means. But here's what matters. The interest payments alone on that debt now exceed $1 trillion per year. That's more than the defense budget. And there is no plausible scenario under current policy where this debt gets repaid through conventional means like tax increases or spending cuts. The math simply doesn't work. Just like in 1971, we're making promises the system can't keep. Warning sign number 2. Eroding international confidence in the dollar. In 1971, it was France under Charles de Gaulle leading the charge to redeem dollars for gold. Today, we see China, Russia, Brazil, and other nations actively working to reduce their dependence on the dollar. They're building alternative payment systems. They're settling trades in their own currencies. They're accumulating gold at the fastest pace since 1967, the year before the London gold pool collapsed. Central banks around the world added over 1,000 tons of gold to their reserves in 2022 and 2023. That's not happening because gold pays interest or generates cash flow. It's happening because these countries are losing faith in paper currencies and want hard assets that can't be inflated away or frozen by political decisions. Warning sign number 3. Persistent inflation pressures despite official assurances. After Nixon closed the gold window in 1971, inflation became endemic throughout the 1970s. Today, after years of unprecedented monetary expansion, quantitative easing, pandemic stimulus programs, deficit spending at levels that would have been unthinkable a generation ago, we're seeing similar inflationary pressures. The official response sounds eerily familiar to 1971. Don't worry, this is transitory. We have the tools to manage this. The system is sound. Trust us. Now, does this mean another monetary collapse is imminent? Not necessarily. Systems built on contradictions can persist for surprisingly long periods before they break. The gap between unsustainable and unsustained can be measured in years or even decades. But what it does mean is this: the warning signs that preceded the 1971 collapse are present again in today's monetary system. The fundamental contradiction remains the same: unlimited currency creation meeting finite real resources and finite international confidence. The question isn't whether the current mathematics of debt and deficits are sustainable. They're objectively not. The question is how long collective confidence can sustain a system built on those contradictions before something breaks. History suggests we should be paying very close attention to these patterns. The death of the gold standard on August 15, 1971, wasn't the failure of one president or one decision made in isolation. It was the inevitable mathematical consequence of a system that promised stability while creating the conditions for its own destruction. Every fiat currency in human history has eventually failed. Not some of them, not most of them, all of them. The dollar has now survived for 53 years without gold backing, longer than most fiat experiments. But survival isn't the same as sustainability, and longevity isn't the same as stability. The pattern is clear. The warning signs are recognizable. The mathematics are unforgiving. Whether we're watching the same cycle unfold in slow motion right now, or whether this time truly is different, is a question each of us has to answer for ourselves. But understanding what happened in 1971 and why it happened gives you the tools to recognize the pattern if and when it appears again. Because the rules of money can change in a single evening. And they have before, and they will again. Make sure you understand the system before it changes around you.